Hey, hello everyone, welcome. We'll be starting in just a few minutes. While I'm waiting, I put a strategy booklet in the chat box. That's free for you to download and peruse. Basically highlights the strategies, the patterns, and turns out there's all kinds of scientific validity to what we're doing here. Thanks, Dwight. Hey, Marlene. So we've got about a minute or so, and then I'll start. Hey, Jasik, Fiona, thank you. Looking forward to having you. We've got Alex from Brunei. I thought you'd be watching the World Cup, Alex, rather than watching this. Marius, nice to be part of it. Marlene, you're welcome. So welcome, everybody. I guess I'll get started. So welcome to this 3-day live trade execution webinar series, subtitled How to Capitalize on Monster Moves in the Markets and Also Avoid the Market Traps. My name is Mark Shawson, the Pattern Trader. We have many members of the Pattern Trader on today's webinar. Always good to see some familiar names. But for those of you who don't know me, I'll just kind of give you a brief background. I've been trading for probably more decades than I care to acknowledge or remember. But I started, in my youth. I was, I think in my second year of college, I was going to one of the best business schools in the country, University of Southern California in Los Angeles. And I was studying what we call fundamental analysis in my business classes. Fundamental analysis really looks at each investment, tries to break apart. And like for a stock, you'd look at the price earnings ratio or the inventory turnover or the quality of the management and things of that nature. But around about the time that I was going to all these business classes, my father was doing business with this investment banker by the name of Graham Loving. And by day, Graham was an investment banker, but he was also on the side very actively trading the commodities futures markets. Now, these were everything from cocoa to orange juice to live hogs to soybean meal to T-bond futures. He was basically trading about 18 different markets at the same time. And these were the most exotic, non-correlated markets, on the planet. And I was wondering, well, how in the world is he able to do this? How is he able to understand all of these different markets? And then I found out that really understanding was counter to Graham's philosophy and Graham's approach. And really what Graham was doing is he was just taking a very simple piece of graph paper. This was before the days of the internet and fancy charting services and what have you. And he would just plot an X and Y axis for time and price. And then he would just plot the daily closing of live hogs or soybeans or wheat or gold. And, after a few weeks, he'd say, Mark, I'm simply trying to buy a market that's going up and sell a market that's going down. And to my very simple way of thinking, that really appealed to me. And from my early learnings of Graham, and what we call price action trading. It's called technical analysis or price action trading. I evolved what is now my 4-step trading methodology exclusively based on price. So I'm always asked the question, do I trade the news? And the short answer is no, because to me, the markets are what I call a discounting mechanism. They are ahead of the news. So, core to my trading philosophy is that, price is the truth, price is the news. Price to me is a religion. It's the only truth, because price is, and this is a very difficult concept even for savvy traders to understand, that, we all think that the markets are trading based on what's going on, but the markets are really a discounting mechanism. They are a forward-looking mechanism. So we might be going into the worst recession, but in a perverse thing, the market actually could be going up because it actually could be saying, hey, we're almost out of it. And I'm just using that flippantly. I don't think that is the case. I think we are going to a bad recession. I think there's another down leg in the market, but the market tells us where things are going to go. And we just have to follow what the market is telling us. If we, try and understand things, if we try and follow what Jay Powell's saying and follow the M2, and, the market is moving well ahead of that. And so this is my core philosophy. This is everything I believe. This is everything I trade. I'm an educator, but I am also very much a trader. And I love trading. I just love the purity of the markets. The markets are the only place now where you don't have any bullshit, where somebody's not trying to control you or spin you. There is no spin in the markets. You can't get away from gravity. The price always reflects the inherent value of something. Now, sometimes it gets out of whack. Sometimes we have these crazy situations like GameStop or Bitcoin, where in the moment, we have a lot of froth and things get out of whack. But eventually, price has to reflect the inherent value of everything we're trading. And so it is the only thing that I base, my trading on, my risk management on, and basically, price charts give us ways and levels to see how to enter a position. If you just have a general idea, hey, I think the euro is going up, and you're just going to buy it because you read something in the Wall Street Journal, that's really not going to be a very effective strategy. And then price charts also give you levels of where and how to assess your risk. So if you have those two pieces of information, where to join a good trade and how to control your risk, that, my friends, is the holy grail of trading. We've always heard this elusive concept, if only we had, tomorrow's newspaper, or if only we had this, that would be the holy grail of trading. Well, let me tell you, this is as close as it's going to get. If you know how to join a good trade and manage your risk, that's all you really need. So the advantage of price action is you can identify where to buy or sell without second guessing yourself, how to time your entries and exits, how to protect your risk and maximize your profits. And it also allows you to trade in bull or bear markets. So it doesn't really matter what's going on. Most people are buy and hold, and their whole philosophy is, in a down market, I have to wait for things to go against me, and then maybe I'll buy in the future, or I'll wait for it to come back. Well, I find that absolutely crazy. So you can actually make a lot of money in down markets. That's frankly where I make most of my money. And then you can also use price analysis on any trading instrument that you choose to trade, whether it be a currency pair, a stock, gold, silver, oil, pork bellies. If it's got a daily range, you can trade it. And so, I talked a lot about this today in my boiler room. So we do an early morning session before the US Open. It's called the Boiler Room. If you want to be part of it, we'll let you know. And I basically, went through this to, try and really refine what you really need to become successful. So I think there's all kinds of theories out there. There's all kinds of ways you can trade, but it really comes down to a discipline. And, what does that discipline really mean? So maybe I'll just capture this so I can kind of go through each. So I think, it's really interesting how the market can go up, down, or sideways. And yet, certainly in the FX, people are losing their money very, very quickly. And, why is that? I think there's many reasons we can theorize. To my mind, people are trading on too short time frames, and they're not looking for big enough outcomes on their trades, and they're trading too much. So, putting on a trade, is very easy. We have these fancy platforms now. It's really exciting to put on a trade, and now we have a bet. Now we get to watch. And even if we're losing, at least it makes us feel alive. It's kind of crazy. But, there's two different objectives. And, I would surmise if I asked all of you, why are you trading? Every one of you would say, well, I want to make money. But if I told you, hey, you could only trade once a month, would you still be interested in doing that if I told you could be profitable? A lot of people would find that very difficult because we all like the bump, the juice, the action that comes along with trading. But those are sometimes two mutually exclusive things. Having a long-term goal to make money and trading. And if you trade too much, you're not going to make money. It just comes down to that. So what do you need to kind of be, winning? You need to have discipline. Well, what does that mean? You need to find high probability trades that give you at least a 3-to-1 risk reward ratio. Meaning, if you're looking to risk $5 on a stock, you should see a path to making $15. And that is really the key. Now, this is very different than what most people are doing. So if you're trading the FX market and you're looking for 15 pips, most people are, like putting their stop loss at 10 or 15 pips, and they're trying to do this 5 or 10 times a day. Now, this is only a 1-to-1 risk reward outcome. Now, remember, you also have to pay 2 or 3 pips for every time you trade. And if you're trading 5 times a day, that's 15 pips right there in the spread. So whatever you're trying to make, you've just paid in the costs to trade in and out every day. And that's why people are losing. And now, if you're only got a 1-to-1 thing and you're trading many times a day, you basically need to be 90% accurate on your trades day in and day out. And that's why it's just not sustainable, and that's why people are losing. There's just it's just math. But if you have a 3-to-1 risk reward, meaning if, you're going to risk 50 pips on a currency pair for a 150 pip outcome, you can actually lose 72% of your trades. So it's absolute BS. A lot of people think, well, if I'm winning, 8 out of 10 trades, then I've got a winning system. But if your outcome is very small on each one of your trades, it's just going to be a matter of time before you're losing. Whereas, and this is very counter to most people's understanding, I can lose 5 out of 6 trades and be a huge winner. If I'm controlling my risk and risking, 0.5% to 1% on every trade, so I've lost 5% on 5 trades, and along comes a trade where I make 15%. So now I've lost 90% of my trades and I'm still up 10% or maybe more. And so this is what I look for in my trades. I look for opportunities that are going to translate to bigger winners. And if I don't see them, then I just simply don't trade. Today was a very sideways move. I'm not very active. I'm short some Tesla. I'm long some HYG call options. I bought some dollar yen, and that's about it. Now I'm going to give you something that took me about 40 years to figure out. And I'm going to give this to you. And this is really the holy grail. Once you've identified your trade, you should either buy or sell that trade within the first 15 minutes that the market has opened or 15 minutes before the close. That's it. No intraday trading. That's just gambling. So what do I mean by that? Is that, and we'll talk about, the construct of charts and whatever. So I typically use bar charts. A bar chart basically tells you where the low is, where the high is, and then this little funny thing is where the market closes. And what I try and determine is, so where a market closes is very important to me. Now, how it gets there throughout the day, it goes up, down, down, takes you out, comes back up, and then closes at the high. And you've been through this carnival ride. But at the end of the day, I'm just looking, where does this thing close? Now, obviously, if it's in a trend and there's a pattern, I don't just look at that bar in a vacuum. But now I have something that gives me a lot of information. Again, it has to be within the trend or the pattern that's behind it. But once I see this bar, I have two choices. If I wait till the close, I can either buy some on the close if I think that, it's going to open and pop into the morning, or I can wait, when it opens. So sometimes you get these openings, you get a lower opening, and the stock will open down there. And what I will do is I will use this kind of arbitrage, where if I want to buy something, I get to now buy it lower than where it closed. And then I can put my stop loss pretty close if I think that this reversal, is, going to hold. I can buy it there. And then very oftentimes I'll buy it there and just watch this thing go north. So once I see a bar like this, I have two choices. I can, in the morning, I can buy it on a weaker opening. The smarter thing is usually to wait for the market to confirm what you're looking at and put like a buy stop right above. And I'll explain this 4-step methodology in a minute. A buy stop is simply a resting order above there. So if you surmise, okay, this thing is going to go higher. Now, the market opens and maybe it doesn't. Maybe it just does something like this, like Schlumberger did today. It just opened and went lower. So in which case you weren't put into a losing trade. On the other hand, if the market kind of opens and then it triggers you, now you could be off to the races. But the point is, you have a very simple strategy to enter the market. And then once you do that, then you can put your stop loss or whatever, and then just let it go. Come back at the end of the day, see where it closed, see how you want to adjust your trade. But that's it. You can either trade at the beginning, or if you wait till the close and you see that something's strong and you think it's going to continue into the next day, you can buy. Sometimes I'll just buy something on the close, where I just think that the opening, action is going to continue. But that is the secret, because what it's going to do, it's going to keep you out of making all of the mistakes along the way. The market, is like a magician. It wants to shake you out. It wants to shake the weak hands, give you a false look, get you out here, and then it's back up there. And so if you get trapped into this intraday trading, first off, you're trading too much, and then you're never seeing the forest for the trees. Now, remember, my objective is to take big chunks out of the market. $20 rips, $50 rips, $80, and that's where I make a ton of money. And I'll show you some of my trades. And then we're human beings, we're not bots, so we should only trade 3 instruments at any one time. I don't like to be in actually more than 1 or 2 positions. If you're in 5 or 10 things, there's just no way you can adequately monitor that. And then your emotions are all over the place. And then this is also the key. It's risk management. What does risk management mean? Risk 0.5% on each trade. So if you have $5,000, 0.5% is what? $25. So, if you're looking to risk $5, sorry. So let me just, so if you have a $5,000 account, a 5% risk is $25. And that's what you can risk on a trade. So if you determine that you have a $5 risk on any trade, you can buy 5 shares, depending on the value of the shares and what have you. And that's very simple back of the envelope math. But the thing is, if you only risk 0.5% on a trade, even if you have 10 losing trades in a row, you've lost 5% of your account and you can live to fight the other day, another day. But most, people are like risking 2, 3, 5. And so, an arbitrary random group of trades can now take you down 30, 40%. And if you're down 50% now, you got to make 100% just to get your money back. And so most people get in a hole and they never get out of that hole. But if you have the discipline to only risk 0.5% until you kind of get more proficiency, then maybe you can go up to 1 and then 2, no more than 2. And then what I do is I build a position. So once I get into something, then I just add to it. So in summary, you need to exercise patience, look for the bigger moves, reduce the intraday noise, and then be in control. So I went on quite a bit longer than I thought I would, but that's generally the gist of it. So my 4-step trading methodology is identify the phase or the condition or the market trend. So, again, what does this mean? So people would say there's only typically 3 stages of the market. Market can be going up, it can be going down, or it can be going sideways. But frankly, I look at 2 other, what I call phases, where I make most of my money, which is on the turn, which is when a market's going up, and then all of a sudden it turns and goes lower. And I get in right before it turns. Or if a market's going down and then it goes up. Now, before these do that, they typically put on a price pattern. This is very crude, but you can see this looks like a double top. And that is a reversal pattern that tells us once this thing has been put in motion, it's going to go the other way. Or what we call an inverted head and shoulders, an upside down looking man or woman's head and shoulders. This is a reversal pattern. And so these patterns tell us where to go. So these are the conditions of, this is the only condition the market can be in. And I will trade, most everything, but what I'm not looking for is this. So I don't want to bang it out with my broker looking for the next 30 pips in a trading range that's bouncing all over the place and worry that if I don't hit my take profit, that it's just going to come right back in my face. My objective is to take pieces of the middle out of these big moves, and they happen all the time. And that's what I'm trying to do. So, if there's no trend, typically a trend is one of these. We're just going up or down. What I try and do is I look for what I call a governing price pattern, something that is governing or dictating where prices are likely to head for a considerable period of time. So after I see this pattern, I know that things are going to go down for a while, or things like this is going to go up for a while. Now, I've been saying forever that Tesla is going lower, and today prices collapsed. Now, you could say it collapsed because Musk has taken over Twitter, or there's 1,000 reasons why it collapsed. I was saying it was going to collapse a year ago based on price patterns that were established a year ago. And we'll take a look at that. So once you've kind of identified what is the phase of the market, is it going up, down, is it turning, is there a chart pattern? Then I wait for what I call this insurance bar. Now, you can be an insurance day, week, or month. It depends on the time frame you're looking at. And these, by the way, are the time frames that I look at. So people say, can I do what you do on a 1-hour chart? You can. but you're going to be, seeing a lot more noise, and you're not going to see the truth of the real trend. So what I'm trying to do again is trying to find the big moves. And you can only see that, by looking at the big picture. So what is an insurance day vol? Well, one definition of that is what I call a key reversal. And this is where the market either looks like this or it looks like that, where it went one way at the opening, and by the end of the day, it closed in the opposite direction. It just reversed. And so again, I look at these bars in context with the trend or the pattern. And then the other one is the inside bar. And the inside bar is literally a bar that sits inside the prior day's range. Now, I don't particularly care where the inside day bar closes. To me, what this represents is a storing of energy. It's a very narrow day. It's a very small day, but it usually precedes huge market action. It's like storing of energy. It's the calm before the storm. And then once I've kind of identified all of these things, then I like the market to confirm what I'm looking at. And how do I do that? I put a buy stop above the high of something I want to buy, or a sell stop, which is a resting order, below the low. So in this case, I'm looking for the market to confirm what I'm looking at. So if the next day the market opens and starts ripping higher, I'll never put into this market. So, I was wrong, but I didn't pay the price. And conversely, if I'm looking to buy something, it opens and it goes lower, then no harm, no foul. But by just putting this resting there, I let the market do all the work. I don't have to watch till my eyes bleed. And then if it trips this thing, now I'm automatically put into hopefully a good trade. And that is basically the 4-step trading methodology. Now, in practicality, again, this is what it looks like. I mean, these are my FX trades. I've got some dollar yen. I put on a pound Australian. I told our members yesterday about pound Australian yesterday. And so far it's doing okay. But, these were some recent trades of the past where I said sell the New Zealand dollar versus Canadian dollar. Here was all the reasons I had. Here was what I'm looking at on the chart. And this is what my daily email looks like, where I show what I'm looking at on the chart, the price patterns that are governing it, where to get in, where to put your stop loss. And, I made 150 grand on those batch of trades. This was where I made a ton of cash in gold, selling gold at 1,800, selling silver right around the same time at 21, and making this kind of, dough here, on these trades. This was the dollar yen, where I said buy it at 117. I said this thing's going to go up to 150. This was several months ago. This was in March. And a few weeks ago, dollar yen hit 150. So this is the trade in euro yen. And this is what I made on those collection of trades. So, no joke. When you get it right, this is what you're looking at. So these are trades in stocks. These are, extracts from my own account. These are real trades. This is not a demo platform. This is on QuantumScape, where I short 44,000 shares. And I made about, $10 on that trade and made over 300 grand. This was in Lyft. And this looks all bad and stuff. My broker statement doesn't look like an FX statement. But I made hundreds of percent buying the stock. Here I bought the option for 92 cents. Whoops. And got it for $7. That's over a 700% return in like 3 days. So sometimes I'll buy the stock, sometimes I'll buy the option. It's all depending on the price action. So we're going into a holiday week, by the way. Happy Thanksgiving for those of you in the, hope you have a great weekend. Let me just kind of share with you some of my emails. And what, I'm trying to do, in the brief time here, is just show you a philosophy, how I apply price analysis to any chart. I don't care if it's a euro yen or Tesla, it doesn't matter. And so here was my analysis. When was this? This was November 16th, so about a week ago, when Tesla was about $190, and now it's 167, so it's down $30 or 15% from that time. And so this was what I was looking at: the triple top chart patterns, the trend lines here, and that it had broken this long-term trend line at around $200. And you could see when I initiated that trade that this was now hovering below this very, very key support level. So I said just sell, slash and burn. Usually I say put a sell stop. I said sell anywhere at the market. It was trading about $187 at the time. Put your stop loss here. And now once the trade gets going, I'll increase my take profit. But that's kind of the flavor of it. So I said, Tesla has formed multiple long-term bear price patterns. I said, I think it's a good idea to get short this stock ahead of the presumed price collapse. And that's exactly what we're seeing. Now, I've been saying this for a year now, because you can look on every time frame, daily, weekly, monthly, and you can see how price is ahead of the news. So, at the time that Tesla made an all-time high, Elon Musk was a cult personality. They were selling more EV cars than anybody else, and everything was great. But the price was starting to tell us that there were problems. So this is your very classic looking double top. And a double top's exactly what it sounds like. You can see it hit one peak once, another a second time. And now we have this M top. And now this, I've been saying for a year, this is like a cheat sheet for dummies. This told us everything we need to know about Tesla and where it was going to go, in what time frame, how it was going to get there. That's always the challenge of trading. But once this pattern was triggered, it told us that this thing is going lower, and it's going to go a lot lower. So there were all kinds of red flashing warning signs in the form of just the price action of this stock. So, you can actually look at this whole thing as a big double top right here. And then if you really want to hone out, you can see that you have a shoulder here, you have what's called a head here, and you have a shoulder here. So when you stand back, it looks just like a man or woman's left shoulder, a head, and the right shoulder. And here's the thing, it just really confirmed this big, bad, long-term thing. So instead of just we can say, wow, this has come down a lot. Surely, it's over by now. This downtrend's over. Frankly, it hasn't even started. So sometimes we can use these patterns to create measurements. We can kind of measure the curtains and the drapes. And so if you take a measurement from this neckline, which is simply a line that's drawn through the pattern, to the peak, around, so 180 to 400, my math's really bad, that's $220. Let's say, you take 60% of that measurement. It takes you down to here. This stock is literally going to be ground into the dirt. This will be a $40 stock, a $30 stock, probably a $20 stock. And I was saying that here. I can show you all of my previous, emails going back a year. I said, this is what we call a parabolic implosion. And those were the words I was using in my email. And this is basically when something goes straight up, it usually comes back down the same way. It's like one of those, airplanes at, those kite shows, those festivals, you hear them going straight up in the air, and then you hear the engine just sputtering out, and then it just crashes back down to earth because it's run out of energy. This is what's happening here. So now the gun has just been fired. You've actually just now broken this key neckline, and it's, you know, it's hats off. So you can see right here, this was the $200 area. So when I gave my trade, the daily trade, we were trading just under this $200. I said, you know, we've cracked this support line. Now we're going to hurdle to the next support line, and then there's no support thereafter. There's like nothing. There's nothing in the way to stop this thing from falling. And so it's going to go into a free fall. Now, it's not to say that these things can't have reactions and then they go again. So what I do is I look at the patterns, and then I look at the price action within the patterns. And you can see very clearly here the idea of what I call these key reversals. The market makes a new high and it closed on the low, makes a new high, close on the low. Right here, it had 3 bars, makes a new high, close on the low, makes a new high, close on the low, makes a new. So collectively, all of these guys are actually pointing in the direction where the stock wants to go. So this is why I say you don't need a newspaper. You don't need to read annual reports. The price will tell you where it wants to go. Here was the last key reversal just a few weeks ago. Made a new high, close on the low, and it's pointing in the direction where this thing's going to go. And so now, you know, once you kind of understand the game, you know, once you kind of understand right here what's going on, then all of these rallies, you can just mindlessly short into, because this tells you it's over. So that, you know, any rally we get, you know, comes here, bounces back up here, short it. Comes back here, bounces here, short it. Comes up here, short it. It's like there's no ambiguity to me. So this is where, you know, sometimes it just gets to, you know, trading for dummies. The market tells us exactly what's going on. Now, intraday, if you're watching this thing's like a beach ball all over. You can't manage your emotions, and it's all over the place. But if you understand what's going on here, then you could have taken advantage of everything that's going on now and in the future. So are there any questions on kind of the methodology? I mean, you know, I don't want to look at 100 different charts. Really what I want to do is impress upon you a way of looking at a price chart. And it doesn't matter what this is. This could be corn, natural gas. It doesn't matter. If something takes the shape of this, short it. Are there any questions? So let's see. This was my email yesterday. I kind of said cash versus trash, where I showed, despite all the carnage, I don't know if you can see it really, but the Dow Jones is only down 7% for the year. Meantime, growth stocks, you know, like Zoom and whatever, some of them are down 60 or 80%, but this ETF that tracks them is down about 40%. So you can see this is a market of stocks, not a stock market. Some are going up and some are going down. So you can't analyze them all the same. So this was, you know, my recommendation yesterday was to buy Home Depot, and then also to buy the pound versus Australian dollar. And you can see I had Tesla, you know, short. In the short column, it was 180 yesterday, and it's 167 today. So the reason why I recommended Home Depot, and this is kind of a funky chart. I mean, sometimes these charts get into certain areas where all you can really do is probe. Sometimes I'm very confident of where I get into market. Sometimes it's just, you know, And it's all about price. You can see that, price has a way, if it touches certain areas, those are very, very key areas. So it's very important to know where, the areas of, what I call accumulation. Now, similarly, there's kind of areas of what I call supply, where there's overhead resistance here. So when we get up here, I can imagine there's going to be some turbulence. So there are certain areas of the chart that are pretty important, but really what I look at is what I'm seeing here is what we call an Adam and Eve bottom. Why it's called Adams, because you get one single spike that tested this low and bounced, and here you get multiple at the same level. But whatever you want to call this thing, it looks like a bottom. And if something is bottomed, it's going to find a way to do what? Go higher. So all we want to do is find these patterns that are going to govern and dictate prices going forward. Now, sometimes it gets very tricky, very nuanced. You're in an area where there is some, distraction. But by and large, why I sent this out yesterday is that before today, this is basically what it looked like. It kind of closed last week, and it had this kind of inside bar. So this is, again, an example of, I look for the chart pattern, and then I wait for what I call my insurance bar. Now, this is a weekly chart, which means that each one of these price bars represents 1 week in time. It's not a 5-minute chart. So there's more credibility to a weekly bar than a 1-minute bar. And so this is what we have here. You can see that the range from low to high last week sat within the high and low of the previous week. And so what I look at this is that this is a coil. It's a storing of energy. Now, energy can go that way or it can go that way. And I'm surmising that it's likely to go higher because of the collective patterns and trend. And sometimes all we can do is poke around, buy it here, put our stop loss here, and see how this thing goes. And so today it just gapped higher, just gapped open higher. I didn't know. I put out my analysis. I had no clue. And you can see we just opened. So how did I know this thing was going to go higher? Because this pattern told me. Tyrant says, isn't it hard to trade a stock like Tesla with a count of only $5,000? Not really. You just have to allocate your trade accordingly. So, it's $170 stock now. And, even if you bought or sold short one share, you would have made $13 today. And what is that? 3%. So why would you not? It doesn't matter what the size of your account is. It's really how you allocate your trade. So most people will trade a small account, and then try and, magnify it. So, if you got short here, at, whatever it was, why can't you be short? One share costs you whatever, $170. And, if you risk, whatever it is, 5,000. So you have a $5,000 account and a 1% risk is $50, right? So basically, you could put a $25 stop loss and get 2 shares. And now you're up, whatever, $60 today. And, you're up 1% today. So I don't see why you couldn't trade it with a smaller account. You just have to trade your lot size accordingly. So when I put in this thing to get short, I think it was like a $13 risk. Get short there, put a $13 risk. And so, if you had 2 shares and you risk $13, even if you get clicked out, you lost 26 bucks or 0.5%. But now, you're down, if you shorted at 200, you're now up 60 bucks. You're up, 1.5% in 2 days. So I don't see why you couldn't do that. Al says, when you get in a trade, what do you look for when you exit? Every trade is different. Really depends where you are in the trade and where the levels are. So for instance, here was obviously a tricky level. So, if you're in this trade and you're kind of bumping into this area, you kind of know that you're going to get some turbulence. So you could choose to kind of lighten up your position or what have you. So every trade, and now the thing is there's no resistance. So it's somewhat arbitrary. And if you have the patience, this thing will be trading under $100 at some point, probably in the not too distant future. So now this thing is just gone. Now, why would you get out? Why would you get out? Just leave it. There is no areas on the chart where you can tell where this is going to stop. And then you just see where it's going to stop. And then you can elect to just take some off there and wait for the bounce. So I always say, the market gets me in, and you had this funky little symmetrical triangle here. And so sometimes this is just what we call a neutral thing or something that's in the middle of a trend. But, again, the phase or the condition of this market was straight down. Then there was all kinds of patterns along the way that told you that the kibosh was in. You had a double top, now you had a triple top. So now these guys are telling you what the game is. Then sometimes you get these, interim patterns that are just consolidation patterns. They're triangles, they're flags, they're pennants. There's all types of patterns that are just in the direction of the trend. And then you just watch how it comes out of this. This is exactly where I told my members to short it, right when it triggered underneath that symmetrical triangle. So this is what I do. Basically, I just draw my boundaries, my structure around prices, and then I watch how does the market trade within these structures. And so now, Tesla's in a free fall. So I'll wait till it shows me that maybe there's, kind of a little double bottom going on here and it wants to come off here. Maybe I'll lighten up, but always looking to get short again, because this stock is over. It's going to go into a free fall. Neil says, before entering a Tesla trade, would you wait for a pullback like when adding to the position? So that's a very, the discipline, if you really want to be disciplined, once something's kind of gotten going, this is, you kind of like tomorrow. Yeah. So again, this is an idea where if tomorrow just opened higher, I know that this thing really can't sustain a rally. Maybe there's a little funky gap here and maybe it gets to that. But my mindset is once this starts happening, if I get in here and it does go up, I'm actually just going to sell more, because there is nothing that, is going to turn into a sustainable rally the other way. So now I'll just be aggressive in accumulating stock on the way down. So now this is an example where you can, if it opens higher tomorrow, you could actually just short it here and put your stop loss above there. So you have a very small risk. Or now you kind of have to wait till the close. And then, so let's say tomorrow it, kind of did something like this where you had an inside bar where now you have this coil, and it closes where it doesn't matter wherever. So now there's two choices. The next day you could either buy it there with a very tight stop loss, or you could put a pending sell stop underneath those lows and let the market put you in and tell you exactly where to get in that trade. So I don't really like to chase trades. And so you could, wait till the next time you see an inside bar or some kind of, reversal, and then, when it's ready to get back on the horse again. So, as a thing, the discipline is always the key thing. But, sometimes the market gives you opportunity. Sometimes it will open higher. And so, but that's it. If it opens higher, you short it here, you put your stop loss there. That's one thing. Or you put a sell stop underneath the low, that's the other, and that's it. Now you're done for the day. You're not watching it. You're not trading it every time it's going up and down and all over the place. And that's the discipline. Tyron, you're welcome. Devendra, if you want to find stocks, there are plenty of stock screeners. There are, universes of tens of thousands of stocks out there. One screener that I like is so I put the link in the chat box, and so you can just really play to your heart's content, and you can come here and actually find stocks. If you want to look at things that have bottoms or tops or channels or what have you, you can actually come in here and play around, and this will give you all kinds of different ideas. And then I'll look at this and then see of these which sounds feels like so they show these as bottoms. These aren't bottoms. These are stocks that are continuously on their way down. So their version of bottoms is different than mine. And then you can just come here and hit the screener, and now you can say, hey, I want to look at NASDAQ stocks. I want to look at energy stocks. I want to look at a market cap of whatever, large, and then it'll, create a screen for you. And then what I like about this is that you can just go and look at the charts here. And then I just do this. And then if a chart just stands out to me, then I'll break it apart. But this is a great resource to do your homework. So I think I'm going to end it there. If you have any questions, again, it's really about the methodology. Forget about the trades and what happens on an individual trade. Really what I'm trying to get across today is, where's this thing? A disciplined way to basically approach the market. It's taken me a long time to kind of figure out what works. So you can see a lot of textbooks with a lot of double tops and a lot of different things. The markets will always throw you different looks. And that's the key thing, is understanding which pattern is really governing this thing, which is the fake out. And it's taken me a long time to figure that out. And so I put together a little mousetrap that, this kind of gets me closer and closer to the bullseye of a high value trade. And that's really what you're looking at, is a high probability trade. Am I looking at a setup where if I risk $5, I can make $15 out of this trade? And so you keep looking at the discipline, whittling it back. And then when you find something, then you wait for the market to come to you. Wait for a look. where you can join the trade and also understand your risk. So again, Tesla is a great example of all these examples of where you could have joined this trade along the way. What I call my inside day bars or my key reversal bars or what have you. So, simply once you understand, what's going on, you see this key reversal, you put your sell stop there. Now you have an inside bar. This is an inside day bar right there. That bar is inside the previous day. Even though close on the high, it was a complete fake out. All you have to do is put your sell stop below that, and now you are put into a great trade. So all I'm looking for is understanding a trade, using direction, understanding what direction this in, what is the pattern that's governing or dictating this thing, and then waiting for certain bars to tell me when this makes a new low that basically I can get in here, put my stop loss there. And so now I know where to get in this trade and where and how, and how much I need to risk. So this was two pieces of information. Now, where was going to go from there, how much, when, those are the unknowns. But at least this gives me a way to join the trade. Here was another key reversal, made a new high, closed on the low. I just put an entry there, put my risk there, and let this thing go. So all you really want to do is, first off, understand which way you need to be facing. Sometimes the market will fake you out, and have you faced in the wrong direction. And that's the problem. If you're trading on a 5-minute chart, this looks like a very robust uptrend. And if you're on a 5-minute chart, this looks like, this thing's going to go to the moon. And that's the thing. You need a bigger time frame to understand what the real game is. There's an old saying, at the poker table, if you don't know who the sucker is you. And if you don't understand the big picture, then these kind of moves are always going to sucker you out. Enda, you're welcome. Thanks, Eduardo. Luke says, where was the live trading? The markets are closed, you moron. So sometimes we have, haters, appear in these things, and all they're really trying to do is divert you to whatever they're selling. So, it's a pretty ugly game in this business, but, it's just part of it. I shouldn't react to it, but I get really pissed. So anyhow, thanks, Eduardo. Thanks, Tyrone. All right, guys, I will see you tomorrow. We have a recording. Yeah, I think we will. Just message our support team, support@thepatterntrader.com. So when I said, at the outset that these are live sessions, it means that this is live. This is not a canned evergreen thing. I'm talking in real time. But, I can only deal with markets, the markets at 5:27 p.m. East Coast time are not trading, although you could trade in the after session. So I watch all of these markets and they are actively trading right now. You can trade Tesla right now. You can see they're blinking and they're still trading. So they are live, but, obviously I can't talk about them because they're not really moving. George says, any thoughts on PayPal? All right, I'll take a look at that and then I'll end it there. So yeah, this looks like a pretty, again, the first thing, when I open up a chart, and it could be anything, the first thing I say, well, okay, what's going on in this thing? and I always think of myself, as like if I had a 6-year-old here and I said to him, okay, is this market going up or down? And I think you'd have to agree that this is in a profound downtrend. And then I say, okay, once I understand it's in a downtrend, then I want to find the patterns and the price action that tells me how to kind of join this trade. And you see it all here. Here's the double top and the head and shoulders that put you into this trade. Then you saw the double top right here. You see another double top right there. And, this whole thing has been just a resistance thing where you see all of these areas. This is where the supply is. Every time it hits here, you can't go any further. So this is in a downtrend, and it's, in a down, it's kind of in this funky channel. But basically, and here again, here was your inside bar right there. All you have to do is put your sell stop under yesterday's low, and now you're put into a trade, and who knows where it's going to go. So PayPal looks weak. It just has this cadence of lower highs. So what we would need to do is if this started kind of coming out here, then all of a sudden I go, okay, maybe this thing is changing and we can get on the other side of it, but it's not. So right now it's a profound downtrend, and the trading action is still lower. Thanks, Al. Sometimes I need to be pulled back. I get a long day and I just get testy. So I'll do the SPY tomorrow, Mike. I'll do all the indexes tomorrow. I just kind of wanted to introduce you to this world of price action trading, how to look at everything only looking at price. So this is PayPal. I don't know what their balance sheet looks like. I don't know how many customers they have. I don't know what their revenue forecasts are. I don't care. The market is doing all that work for me. The collective decisions of buyers and sellers every day is telling me, is this going up or is it going down? As Graham Loving once said, you want to sell a market that's going down, and buy a market that's going up. And that's really, I try and keep it as simple as that. Thanks, Sebastian. Thank you, everybody. I'll see you back tomorrow. Thanks, Dwight.
All right, Mark. See you tomorrow.